Hello and welcome to Crypto Weeklies. In this video, we are going to talk about Dogecoin, a meme coin, the original meme coin, one might say, and conduct machine learning based price forecast for Doge, regression analysis, and accumulation strategy. I know it can be a little bit daunting for a meme coin, but nonetheless, we'll be using some of the statistical measures to ascertain whether Doge is overvalued, undervalued, and also provide our summary. None of the content is financial advice. The over the last 7 days, the markets have been down. You can see most of the cryptos are in red, barring a few stable coins. And Doge is not an exception, down by about 15%, but over the last 24 hours rallied by about 5%. Price at around 10 cents. The overall market cap has increased by about 1.2% over the last 24 hours, but it's still close to $2 trillion by market cap, out of which Bitcoin has about 60%, at around 1.2 trillion out of the 2.12 trillion. Doge has consistently been in top 10 cryptos by market cap, at number 8, market cap at around more than 15 billion, volume at around 750 million. In terms of market cap and volume, it's ranked fairly closely 8th by market cap, 13th by volume. Does not have a max supply. Circulating supply max and total supply are essentially the same, but again, if you look at the logarithmic scale growth, and compare between the price chart and the market cap chart, they are essentially converging right now. That means the growth in price is reflected in market cap. Sorry, the vice versa. The growth in market cap is being reflected in price. In terms of where we are in the machine learning based priced analysis, this is the same chart, but again at a weekly average prices in white, and the three scenarios forecasted by our model is the base case for Doge between 10 cents and 13 cents between now and early March of 2025. If on the other hand the markets were to rally, that at a bull case for Doge per the model is between 11 cents all the way to about 36 cents between now and March. This is the 70 percentile bull case, not the mania case, or the extreme bullish case that are usually cryptos exhibit during the post halving year. That is usually at 95 percentile, somewhere between 14 cents all the way to about 71 cents for Doge. Again, and towards March of 2025, if market goes ultra bullish, then again the range is between 14 cents all the way to about 93 cents. So this is the bull case. On the other hand, if the markets were to go down in the last quarter of 2024 and do not recover in first quarter of 2025, the price could be between 4.5 cents and 9.5 cents. So again, the purpose of this forecast is not to tell if the market has to go up or down. That is determined by market forces alone. Again, we can hypothesize why markets could go up or down or stay in a sideways market, but the purpose is more to determine if the markets were to go up based on the historical data and machine learning models trained on those historical data, how high or how low can a particular crypto go. Again, these are weekly averages. If you are interested in raw values, the base case is in here in the tabular format, week by week. Base case forecast, to its left are the bear cases and to its right are the bull cases. At 68% means 1 standard deviation, 95% with 2 standard deviation accuracy, and 99.7% is 3 standard deviation accuracy. So this is all of the content is available on Crypto Weeklies. The link is on the bottom of your screen. You don't have to sign up or pay for anything. All of the content is available. So in terms of and this is just Doge is just one example. The content is available for most of the top 100 cryptos by market cap. The regression based analysis for Doge, this is the polynomial regression function wrapped around the weekly price action of Doge in white, that is the white line, and the pink line is that base or fair value polynomial regression based valuation for Doge, coming at essentially the same price as the current price, coming in at around 11 cents. So that means if Doge were to hold this level, the next key level to watch to the upside is the 26th 26 cent, which would correspond to 1 standard deviation ceiling, and if or the 1 standard deviation was 70% of the time market stays within these bands, the yellow band and the green band, kind of similar to the machine learning forecast. If you remember, the colors associated with 1 standard deviation was yellow to the upside and light green to the downside. On the other hand, if the markets were to go again, the last time Doge rallied in February, March of 2024, the price action touched the 1 standard deviation ceiling and then had significant pullback due to resistance over there. Again, depending on the market structure, several different valuations could be a resistance. In the bear market of 2022, the fair value was the resistance, and when Doge rallied to about 12 cents back then, which was the fair value, there was a pullback. Right now, if the key level to see is if Doge holds the 11 cents, then goes back to 26 cents. And eventually, if you are looking at the tops, the last time the actual top was the 3 standard deviation residual or 3 standard deviation ceiling, and that level at this point in time is at around $1.45. So eventually, if market exhibits that 3 standard deviation move and Doge participating in that 3 standard deviation rally, that could be a key level to watch. If on the other hand, if there are some diminishing returns and again impact of inflation and as such, the 2 standard deviation ceiling is at around 61 cents. So that is again a key level to watch if you were to look at polynomial regression based analysis to understand the expected values. This is not a forecast, but based on historical data, what are the key levels suggested by the models. On the other hand, if there were the floor, again kind of similar to the machine learning based price forecast, the floor is at around 4.5 cents. Coming in between the machine learning price forecast, the lower end of that value is coming in at kind of a similar valuation for Doge at around 4.5 cents. If you would like to focus now on the accumulation strategies, we have 3 models. The important model for DCA is this dollar cost average model. Nonetheless, we'll start with the shorter term model, which is the SMA model, to check if Doge is in a short term bubble or short term undervaluation phase. Per this analysis, this is the relationship between the price and the 20-week simple moving average, color coded and normalized between 0 and 1 risk. The key idea with this analysis is whenever the risk is, let's say, between 0 and 0.1, color coded by this plum color, or between 0.1 and 0.2 risk, color coded in this blue color, that's when most of the decent buy opportunities are for any mean reversion trade as well as short term bottom analysis. Right now the risk level is at 0.11, again at a decent buy zone per this model. Again, the last time we left the best time to DCA for this model between 0 and 0.1 risk. Again, you can flip this as saying that if you do a 1 minus risk, that would be the reward. Everything is a risk reward. The lower the risk, the higher the reward. Per this model, at the last time, that is during September 20th of 2024, the risk levels were at 0.2 when the price was at around 10 cents. Again, this is not a linear relationship between price, and this is based on the 20-week moving average, what is doing. The second model is the DCA model. This is the one that takes into consideration the relationship between the price and the fair value regression line. And again, the key idea with this analysis, again, whenever the price is lower than the regression line, that's when, historically speaking, there are decent buy opportunities for Doge. Right now, the price is very close to the regression based fair value at around 11 cents. So nonetheless, the risk, if you were to identify the opportunities, right now we are in between 0 and 0.1 risk level. Again, Doge spends most of the time in this risk level because largely the crypto has this tendency to largely spend in a range bound market, almost spend 3 to 4 years, and if it participates in the bull run, kind of increases the valuation in a step function in an increment of, let's say, last time it was 100x from 1/2 of a cent to about 50 cents, so about 100x at from bottom to peak. Right now it's coming, the ranges for this bear market is between 5 cents and 20 cents. So between that range, Doge has spent most of its time between that level. So it would be key to look at if the peak regression, the last time the peak regression was at around 14 cents and the price went about 3 to 4x higher, 4 to 5x higher than the peak regression. Right now the peak regression is coming in at around 50 cents. So if we account for some diminishing returns, and instead of between 4 and 5x of that, it could be between 2 to 3x. So a dollar, between $1 and $1.50. So again, just to use historical data as an input. So that's again for this model, if the prices eventually peak at around $1.50, DCAing at 10 cents is not the worst idea. Again, not financial advice. In the time based or the time weighted average price analysis, this is the third model looking at the absolute best times to DCA per the relationship between the price and this blue line, which is the time weighted average price. Whenever the price is close to the time weighted average price, that's essentially when the risks are zero. And color codes, again the same color codes that we have used, the plum and the purple color highlights the lowest risk, and it also normalized between again 0 and 1. You can see right now the DCA risk is at around 0.34. Again, the time weighted average price is coming in at around 7 cents, price is at around 11 cents. So you get the idea. Right now it's the third or fourth best time to DCA per this model. If you were to summarize everything in terms of the risk associated based on the moving averages, the 20 week, the 100 week and in red, and the orange is the 200 week in red and 100 week in orange. The 100 week moving average coming in at around 9.6 cents, the 20 week at around 11.9, close to the current valuation, and the 200 week coming in at around 12.45 cents. If we were to normalize the risk per this analysis, right now the risk is at around 0.03 with respect to historical risk levels as elevated as April of 2021 when the risk was 1. At this point in time, relatively low risk per this summary risk analysis. To summarize everything again, the time weighted average price says fourth best time to DCA, the summary risk says the kind of the best time to DCA model again pointing to the lowest risk, SMA model second lowest risk, the regression based valuation exactly at the fair value. The key value to look to the upside is the 26 cents level. The peaks at around $1.50 forecasted, not forecasted but ascertained by using regression based analysis, and the machine learning price forecast at one standard deviation between 12 cents and 36 cents. And if the market structure were to change and go back to mania phase, would be between 14 cents all the way to 93 cents. So that's about Doge. Hope you enjoyed the content. If you did, please subscribe to the channel. Also give this video a like, and hope to see you again tomorrow. Thank you and have a nice day. Bye bye.